Okay, so the conversation on the possibility that rates need to keep climbing, that's a conversation we're having here in Canada as well, considering there is a growing belief rates could have to climb given the lingering inflation worries. And you add to that the near-term worry the U.S. could default on its debts if lawmakers in Washington don't get their act together. Karl Schamotta is chief market strategist at Corpay. He joins us to talk about all these themes. Nice to see you, Karl. Let's start with interest rates. I suppose both the Bank of Canada and the Fed are going to have a lot of work to do next month to sort of give the market a sense on what their thinking is on the plans going forward.
That's right. I think this is going to be a big communication challenge. Clearly, officials on both sides of the border were relatively unified in thinking that they should pause at these meetings a couple of months ago. But now we're looking at a situation where you do have all these cross currents coming to play. And I think the big thing that is sort of upsetting the apple cart, although we are very concerned about the debt ceiling, is the fact that we're still looking at relatively robust levels of consumer demand on both sides of the border. That is feeding through into stubbornly high levels of services inflation, and that is putting rate hikes back on the table in both areas. I don't personally think that we're going to see either of the major central banks hiking rates again this summer, but certainly markets are assigning higher odds than they were a few weeks ago even.
Okay, so you don't think the Bank of Canada is going to raise rates at its next meeting?
No, I don't. I think that the big factor here is, if you look at the background here, we're looking at signs of softening in the economy. So, you are looking at lower levels of retail sales, manufacturing sales rolling over, other activity indicators rolling over, even job vacancies, beginning to come back down a bit. All of that argues toward a more cautious approach. And on top of all of that, I think that, we are looking for more data. If we see stubbornly high inflation numbers for May, stubbornly strong employment growth for May, that might push the Bank of Canada toward a hike. So, that might be in July. But I think this June meeting is going to be still more of the wait and see attitude, still looking at, how the fundamentals are evolving in the Canadian economy before making another, sort of precipitous decision.
We were also talking earlier in the program about volatility levels in the market, and they're pretty low. Obviously we're talking about a lot of serious headlines right now, but are we reading too much into all of this? I mean, certainly on the economy, we've had a long time to sort of get our heads around this issue. What's your sense of the mood of the markets given that low volatility?
Yeah, so it's kind of fun because if you look at different measures, you get very different ideas. Right now, if you look at credit default swaps, they're telling you that the U.S. is poised to default here. Certainly that the risk is substantially higher than it was in 2011 or 2013. However, the fact that the bond prices themselves have changed under the surface is sort of distorting that number. Overall, markets are pretty placid right now. They're pretty comfortable that they know where central banks are going to end. They're very comfortable in thinking that we're going to be on hold for a prolonged period of time and then begin cutting. We're not, looking at sort of the big event risks and the unpredictable sort of monetary policy decisions that drove that volatility level up last year. All that said, clearly there are a number of assumptions that are dangerously vulnerable here. Equity markets, of course, have sort of rallied ahead on AI ideas earlier this year and still, kind of continuing. That's a pretty vulnerable idea. That's something that, could implode in and of itself. And then, that assumption that we're going to have a soft landing in the overall economy, that looks very, very dangerous given the fact that, we have had that sort of buildup of vulnerabilities across both the U.S. and Canadian economies through this period of rapidly rising rates. So all of that, that sort of complacency that we're seeing set in the markets, that could go away pretty quickly. Although if history is any indication, it might be a relatively quiet summer, and then things could get hectic in August or September when people get back to work.
Karl, I also want to get your take on these comments from Saudi Arabia's top energy official, a warning of sorts to short sellers roughly a week before the OPEC Plus gathering, saying speculators should watch out. Let's play that for our audience and get your perspective.
speculators, like anything in any market, they are there to stay. I keep advising them that they will be ouching. They did ouch in April. I don't have to show my cards. I'm not a poker player and I don't know poker, how to play poker, but I got it from a movie somewhere. But, but I would just tell them, watch out.
What do you make of that?
I love the technical term, the ouching that speculators might suffer. We've seen speculators ouch many times over the years. Clearly, you know, I think that he is articulating a desire to tighten oil markets and to offset the declines that we've seen in recent months. You know, he is obviously working behind the scenes here to garner support for additional production cuts. The question, of course, in all of these sort of situations is whether OPEC members themselves are going to be, you know, I guess copacetic and that they're going to actually cut output, and what the overall demand backdrop is going to do. And so, you know, the big pressure on oil markets today is clearly that that we are seeing that softness in demand across the global economy, that the ramp up in Chinese demand that was expected earlier this year is not actually playing out in reality. And so, unfortunately, for OPEC itself, it's very likely that they're fighting, you know, sort of a losing battle here to some extent. They might manage to stabilize prices around current levels, but it doesn't look likely that they're going to succeed in pushing them up dramatically against that, you know, sort of negative demand outlook.
Okay.